while giving you an introduction on the financial management subject, how did I explain it? An organization to start up a business has to raise capital. That capital can be a composition of equity, debt, or loan, borrowings. Okay. So, in what composition are we going to raise the capital? Is it going to be 100% equity or is it going to be 100% debt? So, in what composition is the capital structure going to be raised? For which, what are we supposed to find? We are supposed to find the earnings per share under each financial plan. What is the financial plan? The financial plan is the mode in which the capital is going to be raised. For that, I will estimate the profit. Suppose, just an example, I am starting up my business with 1 crore of my capital. With that 1 crore of capital, I will not start a business blindfolded. I will have an estimate of how much of returns I expect, at least in year 1. If not for a long future, at least in year 1, I will have a visibility on how much of profits I expect, right? So, for the capital to be raised, how much is the earnings that is expected? From that earnings, you will have all that are estimates. Okay, from that earnings, you will subtract the interest cost if you are going to raise the capital in the form of debt. Then you will subtract preference dividend. You will, before that, earnings before tax minus tax, you will have earnings after tax. From that, you will subtract preference dividend. Then you will end up with earnings available to equity shareholders. What is the objective of every organization? The objective of financial management itself is profit maximization in the short run and wealth maximization in the longer run. So, how is the wealth going to be maximized? By maximizing the earnings per share to the equity shareholders. So, for a given capital structure, what will we do? We will prepare an income statement. While preparing an income statement, at the end, you will arrive at earnings after tax available to equity shareholders. I will show the format also, it is there in the screen. So, earnings available to equity shareholders, divide by number of equity shares, you will get the earnings per share. That financial plan will be recommended, that which maximizes the earnings to the equity shareholders. Suppose, for mathematical purposes, if in your question they have mentioned PE ratio. What do you mean by PE ratio? It is price earning ratio. How much is the market price of the share for the earnings? So it is price earning ratio, which is market price per share divided by earnings per share. Having arrived at the price earning ratio, if in case if in the question they have given you the PE ratio, having arrived at the earnings per share from the financial statement, you will find market price per share. That financial plan which maximizes the market price per share will be the optimum financial plan. So, for a question on choice of a financial plan, you will choose that financial plan which maximizes the earnings per share. In case if in a particular sum they have given you the PE ratio also, that financial plan which maximizes the market price of the share will be the optimum financial plan. How do you prepare such income statement? It is prepared as earnings before interest and tax minus interest, earnings before tax, minus tax, earnings after tax, minus preference dividend, earnings available to equity shareholders. Divide by the number of equity shares, you will get earnings per share. Multiply with PE ratio, you will get market price per share. So, what is the capital structure? How is the capital structure of an organization to be framed? You will not blindly proceed further. For a capital to be raised, you will have an estimate of profits. So, here this EBIT is not actual profits. It is only an estimated profit. It is only an estimated earnings. Okay, so all these figures are estimates. That financial plan which maximizes the earnings to the shareholders will be the optimum financial plan. Is the concept clear? Shall we move on to sums? I will not go in the same order as provided in your textbook. I will make sure the content is complete, but I will go in my order only. Now, Please take study note. Study note 9. Debentures are debts. Please take study note 9. In that, please take illustration 27. Please take illustration 27, page number 412. In my book, it's 412. Study note 9, illustration 27. The existing capital structure of XYZ Limited. Are you finding that? The existing capital structure of XYZ Limited is as under. Did you find that? Fine. So we will do this sum first now. What is told here? The existing capital structure of XYZ Limited is as under. Equity shares of rupees 100 each, 40 lakhs. Retained earnings, 10 lakhs. 9% preference shares, 25 lakhs. 7% debentures, 25 lakhs. The existing rate of return on the company's capital is 12%. Income tax rate is 50%. The company requires a sum of 25 lakhs to finance an expansion program for which it is considering the following alternatives. Issue of 20,000 equity shares at a premium of 25 per share. Issue of 10% preference shares. Issue of 8% debentures. They are not going to do all the three. Either of the one only they are going to do. They have three alternatives. What are the three alternatives? One is issue of 20,000 equity shares at a premium of 25 per share. Then issue of 10% preference shares. Then issue of 8% debentures. It is estimated that the PE ratio in case of equity, preference and debenture financing will be 20, 17 and 16 respectively. It is just a ratio. Which of the above alternatives will you consider to be the best? So, having given the PE ratio for the various financial plans, I will find the market price per share. That financial plan which maximizes the market price of the share will be the suggested financial plan. Now, what is this organization doing? It is an existing company. So, they are not going to start fresh. It is already an existing company having an existing capital. How much is the existing capital? Add them all. Equity shares is 40 lakhs, retained earnings is 10 lakhs, preference shares is 25 lakhs, debentures is 25 lakhs. All put together, you get total capital as 1 crore. How much is the rate of return? The existing rate of return on the company's capital is 12% and income tax rate is 50%. Right. But for then, they are planning an expansion program. What is told about an expansion program? The company requires a sum of 25 lakhs to finance expansion. So for that expansion program, how much of capital is required? 25 lakhs. So what will be your total revised capital? Total revised capital will be the existing capital of 1 crore plus additional capital of 25 lakhs. Total revised capital will be 1 crore 25 lakhs. What is the return on capital employed given to us? 12%. So what will be your earnings before interest and tax? It is 15 lakhs. 1 crore 25 lakhs into 12%. So that is how you get EBIT. Whatever is the financial plan, EBIT will not change. Why? Because whether I'm going to raise in the capital, additional capital of 25 lakhs, whether I'm going to raise it in the form of debt or equity, my earnings before interest and tax will not get affected. Okay. It is based on the return on capital employed, which is 12%. So whatever is the mode, whether it is plan 1, 2 or 3, the earnings before interest and tax will remain the same. Then coming to the interest component. Now coming to the income statement. What is happening to the income statement? EBIT is 15 lakhs. Let me tell you plan 1 first. Then I will get into plan 2. What is told in plan 1? That additional capital of 25 lakhs is required. Now, how are they going to raise it? Issue of 20,000 equity shares at a premium of 25 per share. Fine. So what will happen? EBIT minus interest. What is the interest here? That interest will be only on the existing debt. I am not going to raise additional debt. How much is your existing debt? Look into your existing capital structure. In your existing capital structure, they have told 7% debentures, 25 lakhs. What is that 7%? That is the rate of interest. So 25 lakhs into 7% will give you 1,75,000 as interest. This interest is on existing debt. Existing debt will remain common in all the three plans. So the existing debt is 1,75,000. EBIT minus interest will give you earnings before tax. How much is tax given? Look at the point which is given in the question. They have told income tax rate is 50%. So on earnings before tax, apply 50% for taxes. You will get earnings after tax. Minus preference dividend. There is some preference capital which is mentioned in your existing capital structure. How much is it? In your existing capital structure, you have 25 lakh preference shares. What is the rate of preference dividend? They have told 9% preference shares. So 25 lakhs into 9%, 2,25,000 will be the preference dividend. How did you arrive? 15 lakhs is EBIT. I just told you. On the total capital, please follow as and when I say. 1 crore is the existing capital, 25 lakhs is additional capital. 1 crore, 25 lakhs is the total capital. On that, 12% is returned. So that is how you get 15 lakhs. 1 crore 25 lakhs into 12%. Right. So EBIT minus interest will give you earnings before tax. Minus tax will give you earnings after tax. Minus preference dividend will give you earnings available to equity shareholders. Can I ask you people one thing? You please keep your doubts until I complete my explanation. After I finish the sum, I will ask, did you all understand? There you ask your doubts. Because every time there is a pop-up coming up, it's distracting me. Please keep your doubts reserved until I complete the complete explanation. After that, when I ask, did you understand? You can ask me your doubts. I appreciate your interaction, but please keep it reserved for the time being. Right. Earnings after tax minus preference dividend. How is preference dividend computed? It is computed as 25 lakhs into 9%. How is that 25 lakhs coming? For your existing capital structure, they have told 25 lakh preference shares. On that, 9% is the rate of dividend. So it is 2,25,000. I am explaining column 1 only now. I am yet to get into column 2. Have some patience. So 6,62,500 minus 2,25,000 will give you earnings to shareholders. How many number of shares is the organization holding? The organization is having an equity capital of 40 lakhs. How much is the face value? 100 each, which means how many number of shares? 40,000 shares. For plan 1, how much of additional equity shares are going to be issued? They have told 20,000 equity shares at a premium of 25. So there are 20,000 additional equity shares, which means total equity shares is 60,000. 4,37,500 is the total earnings available to shareholders. Divide by 60,000 shares will give you earnings per share. Earnings per share into the price earning ratio will give you the market price of the share. The price earning ratio is given before the question, which of the above alternatives? Before that, if you see, it is estimated the PE ratio in case of equity, preference and debenture financing will be 20, 17 and 16 respectively. So it is 20 for the first plan. Earnings per share into price earning ratio will give us the market price per share. This is plan 1. Now coming again to plan 2, whatever is the plan which is chosen, EBIT will remain the same. What is happening to interest? It is on existing debt. Now I am telling only plan 2. What is the interest? It is only on existing debt. Why? Because in plan 2, the additional money of 25 lakhs, they are going to raise by issue of preference shares. So there is no further debt. How is this 1,75,000 arrived? It is interest on existing debt. How much is existing debt? 25 lakhs. How much is interest rate? 7%. So 25 lakhs into 7% will give us 1,75,000. 15 lakh minus 1,75,000 will give you 13,25,000 as earnings before tax. Minus tax at 50% will give you earnings after tax. Minus preference dividend. How much is preference dividend? For the existing capital structure, that is 25 lakhs of preference shares, 9% being the preference dividend. 2,25,000 is the preference dividend on the existing structure. Now under plan 2, how am I going to raise the additional capital? Under plan 2, the additional capital of 25 lakhs, they are going to raise by issue of 10% preference shares. What do you mean by 10% preference shares? That 10% is the rate of dividend. So 10% on what am I going to apply? I am going to apply it on additional capital. How much is additional capital? 25 lakhs. 25 lakhs into 10% will give you 2,50,000. That is the preference dividend on additional capital. So earnings after tax minus the total of preference dividend will give you the earnings to equity shareholders under plan 2. Under plan 2, how many number of equity shares will you have? You will have only the existing equity shares. Why? Because the additional money, 25 lakhs, I am going to issue preference capital. It is not based on equity capital. So only the existing equity shares will continue. So it will be only 40,000 shares here. Earnings available to shareholders is 1,87,500. Divide by 40,000 will give me the earnings per share. Multiply with the PE ratio which is given will give me my market price per share. This is plan 2. Then moving on to plan 3. What is told in plan 3? Again, EBIT will remain the same. What happens here under plan 3? Under plan 3, the additional capital of 25 lakhs, how are they going to raise? Issue of 8% debentures. So, the additional capital is here going to be raised in the form of issue of debentures. For debentures, we have to pay interest. So, 15 lakhs is EBIT. Interest on existing debt is 1,75,000. Now I have some additional debt. How much is additional debt? 25 lakhs. How much is the rate of interest? 8%. So 25 lakhs into 8%, you will get 2 lakhs as interest on additional debt. 15 lakhs is EBIT minus interest, you will get earnings before tax. Minus tax, which is 50% on earnings before tax, you will get earnings after tax. Minus preference dividend. Here under plan 3, the additional capital we are going to raise in the form of debt. So there is no additional preference dividend. You will have preference dividend only on the existing capital. So that is 2,25,000. Earnings after tax minus preference dividend will give you earnings to shareholders. Divide by number of equity shares. How many equity shares will you have? You will have only 40,000 equity shares. Why? Because the additional money I am going to raise by issue of debentures. So the existing existing number of shares holds good. So it is 40,000 shares. 3,37,500 divided by 40,000 shares will give you earnings per share of 8.44. Multiply with price earning ratio, you will get the market price per share. What is the rule for choice of a capital structure, choice of a financial plan? The rule is that which maximizes the market price per share will be the recommended financial plan. Which plan maximizes the market price? Maximum is 145.8. For which plan? For plan 1. What was plan 1? Plan 1 was issue of equity shares at a premium. Hence, the expansion can be financed by equity as it maximizes the market price of the share. That's all. Now ask your doubts. Is this sum clear to all? And please ask your doubts now. Good. For those having doubts, there were so many questions. EBIT is earnings before interest and tax. Profit before tax. EBIT is earnings before interest and tax. EBT is earnings before tax. Only if you find for all, you will know the best option. You will know the correct option. Only on comparison, you are able to identify which is better. Once more, if I get the question how to join WhatsApp group, I will throw you out of the class. EBIT of 15 lakhs is calculated as the total capital into 12%. Yeah, earnings after taxes, PAT, EAT or PAT. Correct. 1 crore 25 lakhs into 12% will give you EBIT. Is the concept clear? Is this some clear to all? I just told you, na. Only if you find for all the three alternatives, you can compare and find which is better. How do you know that plan one is best? Only on comparing with the other two alternatives. Is it clear? Right. So now please take the next sum. Please take illustration 28. Please take illustration 28. Excel Limited provides you with the following figures. Profit is 2,60,000 minus interest on debentures at 12% is 60,000, netting out to 2 lakhs. Income tax at 50% is 1 lakh. Profit after tax is 1 lakh. Number of equity shares is 40,000. Earnings per share is 2.5. Ruling price in the market is 25. PE ratio is 10. So they have given us the income statement already. Then the company has undistributed reserves of rupees 6 lakhs. Let me tell you people one thing. I will read the question completely. I will explain the question. I will explain the solution. Until then, please have some patience. After I complete the sum, in case if you have any doubts, you can ask me. Until then, you can note it down in your paper. In case if you are going to forget, you can note it down in a rough paper or in your notebook itself. Put a question mark for yourself. Don't put it in the chat box and then ask me at the end. At the end in the sense after each sum. Don't interrupt in between. Now, the company has undistributed reserves of rupees 6 lakhs. The company needs 2 lakh for expansion. This amount will earn at the same rate as funds already employed. You are informed that a debt equity ratio, which is debt divided by debt plus equity, more than 35% will push the PE ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. You are required to ascertain the probable price of the share if additional funds are raised as debt, if amount is raised by issue of equity shares. Okay, I will explain what is told in the question now. What is told? They themselves have given us the profit information. How much is it? 2,60,000 minus interest. You have profit before tax minus tax, profit after tax. Divide by number of equity shares. They've given us earnings per share. They have told the market price of the share and also the price earning ratio. Further, what have they told? The company has undistributed reserves of 6 lakhs. So what is that? That is retained earnings. Then the company needs 2 lakhs for expansion. Fine. Here again, it is an existing organization which is planning some expansion. This amount will earn at the same rate as funds already employed. So the profit from the existing capital will be at the rate at which the profit is generated from existing capital will be the same rate at which the additional capital also will generate earnings. You are informed that a debt equity ratio, they have mentioned the formula also, debt divided by debt plus equity, more than 35% will push the PE ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. you are required to ascertain the probable price of the share. So they are asking us the market price of the share. Under two alternatives, here there are only two alternatives. What are the two alternatives? If additional funds are raised as debt, if the amount is raised by issue of equity shares. Those are the two alternatives. If you have to compare this illustration 28 with illustration 27, why am I comparing? For better understanding. What is happening under illustration 27? They have given you the existing capital structure, correct? We totaled up and found 1 crore. Here, have they anywhere told the existing capital structure? Have they anywhere told about the existing capital structure? No. They have told only the amount of undistributed reserves. So, like in the earlier sum, we have to find how much is existing capital structure. Why? Because they have told the company needs 2 lakh for expansion. This amount will earn the same rate as funds already employed. How much is the earnings? That earnings is the first line of profit, which is 2,60,000. That 2,60,000 is my profit, fine. But on how much of capital? I should know the rate, na? Only if I know the rate, I can apply that rate on additional capital to know the additional earnings because of expansion. So, my first step will be to draft my existing capital structure. I will compare it with profits made during the year, which is 2,60,000 to know the rate of return. I will apply that rate of return on additional capital to know the additional return because of expansion. Then I will analyze whether I have to raise that additional capital by means of debt or in the form of equity shares. Now, how much is the existing capital structure? I will pick out information from the income statement itself. What is told in income statement? They have told interest on debentures at 12% is 60,000. Interest on debentures is given as 60,000. How much is that interest? It is 12% on debt. Correct? They have told interest on debentures at 12% is 60,000. When 12% is 60,000, on what I would have applied that 12% to arrive at 60,000? It will be 60,000 divided by 12%, which means my debentures is 5 lakhs. How am I arriving at it? 60,000 is interest, which is 12% on debt, which means how much is debt? It is 60,000 divided by 12%. So I get debentures as 5 lakhs. Then coming to equity, look at the number of equity shares of rupees 10 each, 40,000. 40,000 equity shares, 10 each. 10 rupees each. So 40,000 into 10, 4 lakh is equity. How much is the reserves? Undistributed reserves is 6 lakhs, which means what is your total capital? It is 15 lakhs. How much is profit? It is given as 2,60,000, which is first line of the table. So 2,60,000 is the profit which is made out of 15 lakhs of capital, which means what is the percentage of return? It is 17.33%. Why am I finding 17.33%? They say in the question, this amount, which amount? The 2 lakh of additional capital, na? That amount will earn at the same rate as funds already employed. So, for the funds already employed, how much was the rate of return? We didn't know that. We just found it as 17.33%. In the previous sum, if you could see, they gave you the rate of return. The existing rate of return on company's capital is 12%. In the previous sum, they gave you the rate of return as 12%. Here, they did not give you. We found out the return on capital employed as 17.33%. Now, how will I find EBIT? The existing capital is 15 lakhs, which we calculated. Additional capital is 2 lakhs, which means how much is your revised capital? Your revised capital will be 17 lakhs. 17 lakhs into 17.33% will give you an EBIT of 294,610. This 294,610 will be the EBIT, revised EBIT, irrespective of the additional capital to be raised in the form of debt or equity. So this is EBIT. After I find EBIT, I subtract interest. How do you find interest? Now let me do it for plan 1 alone. Then I will get into plan 2. What is under plan 1? 294,610 is EBIT. Under plan 1, additional funds are raised as debt, right? So What is the interest on existing debt? It is 60,000, which is already given in the income statement. That is interest on existing debt. Now the additional capital. How much is additional capital? 2 lakhs. That is going to be raised in the form of debt. What is the rate of interest? The interest rate on additional amount borrowed is 14%. So 2 lakh into 14% will give you 28,000 as interest on additional amount borrowed. 2,94,610 is EIP minus interest will give you earnings before tax minus tax at 50%. How did I know tax is 50%? From the earlier income statement. From the income statement, if you could see, they have told income tax at 50%. So earnings before tax minus tax at 50%, I will get earnings after tax. There is no preference capital in this sum, so the preference dividend is nil. I will arrive at earnings available to equity shareholders. Divide by number of equity shares. How many existing equity shares do you have? A number of equity shares, 40,000. So under plan 1, I'm going to raise in the form of debt. So there is no additional equity shares. Earnings available to equity shareholders, divide by number of equity shares, I will get earnings per share. But what is happening to the price earning ratio? They have told in the paragraph below the table, you are informed that debt equity ratio of debt divided by debt plus equity more than 35% will push the PE ratio down to 8. So let me find the debt equity ratio. If it is more than 35%, PE ratio will be 8. So why should I know PE ratio? Only then I can find market price per share. So for that, look at this working note. What is the debt equity ratio formula? They themselves have given. They have given it is debt divided by debt plus equity. How much is equity? Equity is owner's equity comprises of not just share capital but also reserves and surplus. So because it is the shareholders entitlement only. Undistributed reserves is also part of equity. So 4 lakh is the capital structure. 4 lakh, how did I get? 40,000 equity shares into 10 rupees each. So 4 lakh is the existing capital. 6 lakhs is undistributed reserves, which means 10 lakhs is total existing capital. What is happening to the additional equity? Additional equity in under plan 2 only. Why? Because under plan 1, what am I going to do? Under plan 1, I am going to raise the additional capital in the form of debt. Only under plan 2, I am going to raise the additional capital in the form of equity. So 10 lakh of equity, here it is 12 lakh of equity under plan 2. Under plan 1, the existing debt was 5 lakhs. Additional debt under plan 1 is 2 lakhs, which means 7 lakhs is the total debt under plan 1. Under plan 2, the total debt is 5 lakhs only. How do you find debt equity ratio? It is debt divided by debt plus equity. So it is 7 lakhs divided by 10 plus 7. So it is 7 lakhs divided by 17 lakhs into 100. It is 5 lakhs divided by 12 plus 5. So it is 5 lakhs by 17 lakhs. There you get the debt equity ratio as 41.18%, 29.41%. What is told in the question? If the debt equity ratio is more than 35%, it will push the PE ratio down to 8. Where is it more than 35? Under the first alternative, it is more than 35%. What will happen to PE ratio? It will go down to 8. Here it is less than 35%. Here it is more than 35%. More than 35%, PE ratio becomes 8. Less than 35%, how much is the existing PE ratio? It is given as 10. That will continue. Why should I know PE ratio? I should know this to find market price of the share. For what? That plan which maximizes the market price of the share will be the recommended plan. Na? So for that, I find the PE ratio from the working note. Now coming to income statement for plan 2. For plan 2, what happens? They have given me the earnings before interest and taxes 294,610. It is going to remain the same irrespective of additional capital raised in the form of debt or equity. Minus interest on existing debt. Interest on existing debt is from the income statement, which is 60,000. Under plan 2, what is happening? I am going to raise the additional capital in the form of equity. So there will not be any additional interest. It will be only the existing interest. EBIT minus interest gives you earnings before tax. Minus tax at 50% will give you earnings after tax. There is no preference capital, hence no preference dividend. Earnings available to equity shareholders. Divide by number of equity shares. Existing shares were 40,000. How many additional shares are going to be raised? On a comparison with the previous sum, they told you issue of 20,000 equity shares. Here they have not told us the number of shares. Instead, they have told the additional capital are to be raised by issuing equity shares. You do not know how many number of shares. At what price will the shares be issued? Shares will be issued at market price. How much is the ruling price of the market? 25 rupees. How much is the additional money you want? 2 lakhs. 2 lakh divided by 25 rupees per share will give you 8,000 additional shares. So totally it is 48,000 shares. 1,17,305 is earnings available to equity shareholders. Divide by number of equity shares, you will get earnings per share. Multiply with the PE ratio to get the market price of the share. On comparing the market price, which is the financial plan you will recommend? You will recommend the financial plan of raising additional capital in the form of equity because it maximizes the market price of the share. Is it clear? Now you can ask your doubts. Please ask your doubts and is it clear? Don't ask a doubt how to get added to the WhatsApp group. Ask doubts from the sum. Please post your doubts. Hello. Additional equity will be issued at ruling price only. Additional equity, how much was the additional money required? 2 lakhs, correct? What is the ruling price in the market? 25 rupees. So 2 lakh divided by 25 rupees is 8,000 equity shares. How do you find? What was the other question? 1 minute. How to calculate existing debt? Existing debt, they have not given me the amount of debt, but they've given me the interest. How much is the interest given? 60,000. Where is it given? It is given in the income statement. 60,000 is the interest. 12%. 12% க்கு 60,000 னா எதுல 12% அப்ளை பண்ணா எனக்கு 60,000 வரும்? 60,000 divide by 12%, 5 lakhs. Is it clear? That face value is for declaration of dividend. Issue price will be the market price. Is it clear to all? Any further doubts? Right. Now we move on to the next concept of capital structure theories. Just a minute. I'm going on mute. I'll come back. Today's class will be until 12:30. If you want to leave, you can leave. We are moving on to the next concept called as capital structure theories. I told you in the last class, when an organization is going to raise capital, it will not be a blindfolded decision, or it will not be because my friend told so much, or my other party told so much, or an experienced fellow told so much. No, it will not be like that. Economists have suggested certain theories in composition of capital structure. There are certain theories developed in the past by economists on the composition of capital structure. So what does those economists say, and what are the concept of those theories? There are totally 4 theories. What are the 4 theories? One is net income approach, net operating income approach, traditional approach, Modigliani and Miller approach. These are the 4 theories which were developed by economists on composition of capital structure. So what does these 4 theories say? Let me explain one by one. Net income approach, that is the first theory. This theory was propounded by David Durant. The man economist is called David Durant. What does David Durant say? He says the value of the firm, which is the composition of capital structure for the firm, can be a proposition of both debt and equity. Value of firm is measured as value of debt plus value of equity. How are we going to find the value of debt? It is interest divided by cost of debt. In the previous sum we did 60,000 divided by 12% gave me 5 lakhs. Right? So what is that? It is interest divided by cost of debt. Value of debt is interest divided by cost of debt. What is this cost of debt? It is interest rate. Okay. Cost of equity will be the dividend which is given. So whatever is the cost of capital is the return to the investor. For the organization, it is a liability. For the liability, the organization has to pay interest if it is a debt. So it is a cost to the company. So cost of debt is the interest, value of debt is the interest divided by cost of debt. Like we did in the previous sum, 60,000 divided by 12% gave me 5 lakhs. So for the interest divided by cost of debt, you will get the value of debt. Likewise, how do you find value of equity? It is earnings available to equity shareholders divided by cost of equity. What is cost of equity? It is the expectation of equity shareholders. What is equity shareholders going to expect from the company? They are going to expect dividend. So earnings available to equity shareholders divided by cost of equity will give you the value of equity. What is the value of firm? Value of firm is a composition of both value of debt and value of equity. What does David Durant say under net income approach? David Durant says that there should be debt in the capital structure of an organization. It cannot be, it should not be, it cannot be there. It should not be 100% equity. Why? Because according to this man, David Durant, he feels debt is a cheaper source of finance. Why? Because in case of debt, you will have only a fixed commitment of interest. How much ever the organization is making profits, whatever is the debt which is raised, I have to pay a fixed rate of interest only on that debt. But what happens if it is equity? Higher the earnings, higher will be the expectation of shareholders in the form of dividend. Interest cannot fluctuate, but dividends can fluctuate. Which means, what will be the cheaper source of finance with more profits? When the organization is in the growth phase and making overwhelming profits, which one will be more beneficial? Which one will be cost effective? Debt will be cost effective. Why? Because it is enough if I pay them only the fixed interest. I need not pay anything extra. If I am making extra profits, it entirely belongs to the organization and obviously to the shareholders. So, David Durant under net income approach says that the existence of debt in the capital structure will maximize the value of the firm. What is maximization of value of firm? It will maximize the wealth in the hands of the shareholders. Why? Because of a fixed commitment alone for debt. The existence of debt in the capital structure will maximize the value of the firm as debt is a cheaper source of finance. How is value of firm alternatively arrived? Here we found value of firm as value of debt plus value of equity. How is it alternatively calculated? It is calculated as earnings before interest and tax divided by, this is referred as K naught. This is K naught. What is this K naught? It is overall cost of capital. It is neither cost of debt alone or cost of equity alone. Overall cost of capital is K naught. The value of firm can alternatively be arrived as EBIT divided by K naught. You can inverse this formula further to get the other information. What is K naught then? K naught will be EBIT divided by value of firm. Let me take you to the theory. Please take page number 401. Net income approach. Did you find that? Please take page number 401, net income approach. Did you find that? Yeah. What is told here? I have already explained net income approach. I will just, 1 minute. Page number 401, net income approach. I have already told what David Durin said under the theory. Let me read it out. What is told? The approach was identified by David Durin. According to this approach, capital structure has relevance. A firm can increase its value and minimize the overall cost of capital by employing debt in its capital structure. According to this theory, greater the debt capital employed, lower shall be the overall cost of capital and more shall be the value of the firm. The cost of debt is less than cost of equity. Risk perception of investors is not affected by use of debt. That is a major assumption. What will happen if I have to explain it more clearly? தமிழ்ல சொல்றேன். கடன் நிறைய ஆக ஆக என்னோட கேப்பபிலிட்டிக்கு ஏத்த மாதிரி தான் நான் கடன் வாங்க முடியும். என்னோட தலைக்கு மேல நான் எக்ஸ்பேண்ட் பண்ண போறேன், கடன் வாங்கினேன்னா காஃபி டே ஓனர் மாதிரி சூசைட் தான் ஆகும். கரெக்டா? There is a risk with more of debt. What will happen? I'm talking 99% in English. Here and there only I'm bringing in examples in Tamil. If you are not able to understand, skip it. So, with more of debt in capital structure, what will happen? There will be a risk of my capability to repay that debt. Correct? That risk is ignored under net income approach. Under net income approach, David Durin says, the risk perception of investors is not affected by use of debt. They are not bothered about the risk involved in debt. Because of debt, 100% you have to repay them. Correct? Later, when the organization gets into liquidation also, the debenture holders are given first preference at the time of liquidation. Only the leftover, after realizing all assets, only the leftover, if there is anything left over, will the equity shareholders get their entitlement. Right? So, what is happening here? There is lot of risk involved in raising capital in the form of debt. But that risk is ignored under net income approach. Then what is told? There are no corporate taxes. So they assume there are no taxes at all. According to the above assumptions, cost of debt is cheaper than cost of equity. They remain constant irrespective of the degree of leverage. What do you mean by leverage here? Leverage is the composition of debt and equity. Suppose if it is 50% debt, 50% equity, 30% debt, 70% equity, or 70% equity, 30% debt. In any combination, it can be 60-40, 50-50, 30-70, 20-80. It can be in any combination. So irrespective, that combination is what we call as leverage. Okay. So irrespective of leverage, debt, if more debt capital is used, it results in cheapness. I told you, debt is a cheaper source of capital according to net income approach suggested by Durin. The overall cost of capital declines and the value of firm increases. What do you mean by value of firm? It is wealth maximization in the hands of shareholders. Is the concept of net income approach clear to you? Now you can ask your doubts. This is the concept of net income approach. Is the concept clear? This approach may be asked either as theory, write short notes on, or they may ask you sums. Let me explain the concepts first and then I will get into sums. Is the concept clear so far? There are totally 4 theories. One is net income approach. The next is net operating income approach. Next is traditional approach. And finally, Modigliani and Miller approach. If this is clear, I will move on to the next. Please respond. Right. Next is net operating income approach. That approach also was suggested by the same man, David Durant. But what is happening here? Under net operating income approach, the same person gives a different view. Okay. Under net income approach, suppose if I am David Durant, I have told one thing, that debt is a cheaper source of finance. The value of firm will enhance with more of debt in the capital structure. All that I have told. Correct? Where? Under net income approach. I myself contradict my statement under net operating income approach. So the same David Durant under net operating income approach says the value of firm is value of debt and value of equity. That is going to remain the same. Please understand the formula will remain the same because it is the same person. Okay, the formula will remain the same, but the opinion only is taking a complete shift from what he told. I will take you to the sum. Please have some patience. I am still explaining the concepts. After this, we will move on to the sums. The formula will remain the same because it is the same person. Both was told by David Durant only. But what did David Durant say under net income approach? He said the value of firm will maximize and the cost of capital will be least. With what? With usage of debt in the capital structure. But under net operating income approach, he says, no, the value of firm will not change. It will continue to be the same, irrespective of the debt and equity composition. Why? Because one is offset by the other. Which one and which one is getting offset? Yes, he still continues to say debt is a cheaper source of finance. But what will happen with more of debt? With more of debt, the organization will be under pressure to make more profits to meet the fixed obligation. What is the fixed obligation? Interest. So with more of debt, the organization will be under a pressure to make more profits to meet the fixed obligation. Otherwise, they will end up in loss. Correct? So with more of debt in the capital structure, he brings in the concept of risk into this. There is more of risk for the organization. The risk for organization will finally end up on the heads of the shareholders. So what will happen to the shareholders? The shareholders want higher returns. That is why they are investing in equity shares. Otherwise, they would have invested in government bonds. So since the shareholders wants more returns, it is always associated with higher risk. So what will happen? There is higher risk because of more debt in the capital structure, which means the expectations of shareholders also will go up, which means the lower the cost of debt, there is also a balance with increase in the cost of equity. Thereby, the overall cost of capital will remain unaffected. What is your overall cost of capital? It is a combination of cost of debt and cost of equity. What is cost of debt? It is interest. What is cost of equity? It is dividend. With more of debt in the capital structure, there is more of risk for the shareholders, which means the shareholders will expect the organization to perform better, which means there is a pressure on the organization to perform more. So with cost of debt going down, it is compensated with increase in the expectations of shareholders. Thereby, the overall cost of capital will remain unaltered. So what is happening under net operating income approach? The value of firm will remain unaffected. How is this value of firm calculated? It is value of debt plus value of equity. The formulae, other formulae will remain the same because it is suggested by the same person. Net operating income approach states the value of firm remains unaltered irrespective of change in capital structure of debt or equity. So please take net operating income approach, page number 403. Let me read that theory. What is told? This net operating income approach is also suggested by David Duran, the same person. This represents another extreme view. So what he told, he himself is contradicting. So it is another extreme opinion of the same person. The capital structure and value of firm are irrelevant. The capital structure does not influence cost of capital and the value of firm. The overall cost of capital depends on the business risk of the firm. It is not affected by the financial mix. The critical assumption are the market capitalizes the value of firm as a whole. Split between debt and equity is not important. The business risk remains constant. There is risk. There are no corporate taxes. The debt capitalization rate is constant. Those are the assumptions for the theory. Is net operating income approach clear? We will move on to sums, not to worry. I will first explain the concept and then we will move on to sums. Is net operating income approach clear? Next, coming to the traditional approach. For traditional approach, I have not given any notes as such because it is very simple. Please take page number 405, the traditional view. What is told in traditional view? Traditional view was suggested by Ezra Solomon. The name of the person is Ezra Solomon. What is told under traditional view is that the composition of debt and equity actually does not matter for the organization. He says, he suggests David Duran's recommendation. He says, yes, debt is a cheaper source of finance. Yes, agreed. But to what extent? It depends on the performance of the organization. So, what am I trying to convey is, under traditional view, they are not specific. They are not specific on how much should be debt and how much should be equity. He says, debt is a cheaper source of finance, but up to a certain level. Beyond that level, debt becomes expensive. What is that level? They have not specified that level. So, they are not clear on their specification. Hence, traditional view is no longer applicable. What is told under traditional view? Let me read it. It is a compromise between the two extremes of net income approach and net operating income approach. According to this approach, cost of capital can be reduced or the value of firm can be increased with a judicious mix of debt and equity. This theory says cost of capital declines with increase up to a reasonable level and later it will increase further with rise in debt capital. So what is that reasonable level? They have not specified. There is no specification on how much of debt should be in capital structure. They have left it absurd. They have told reasonable level. That reasonable level can differ from one person to another, can differ from one organization to another. Hence, this theory is considered absurd because there is nothing told specific for this theory. That is traditional approach. Next comes the last approach, which is Modigliani and Miller approach. What does Modigliani and Miller say? He is a more practical person. Modigliani and Miller is the man who suggested this approach, and he is a very practical person. Can I assume no corporate taxes in a corporate world now? No. Every organization has to pay corporate taxes, otherwise the license will be withdrawn. Correct? So, first and primary condition is Modigliani and Miller believes there are corporate taxes. But David Duran said there are no corporate taxes. So, first condition under Modigliani and Miller is yes, there are corporate taxes. Modigliani and Miller also said that the composition of debt and equity in the capital structure is not going to influence the value of the firm. Why? Because he follows the same proposition of David Duran under net operating income approach. The value of firm will remain unaltered irrespective of debt equity mix. The overall cost of capital will be compensated. With a lower cost of debt, there will be increase in cost of equity and the overall cost of capital also remains unaltered. So, it is generally called that Modigliani and Miller approach is an extension of net operating income approach. Under net operating income approach, I believed there were no corporate taxes, but under Modigliani and Miller approach, I include corporate taxes. So it is an enhanced version of net operating income approach. Is this clear? You should know two more formulae. B by S ratio is borrowings by shareholders' funds. B by V ratio is borrowings by value of firm. Those are the two formulae which you should know. Is it clear so far? Is it clear so far? Fine. There is one more concept under Modigliani and Miller which I will teach in the next class. Now for whatever I have told, let's do 2 or 3 sums and then I will wind off the session. Please take illustration 22. It is not 9. It is 9 as per the old edition book. So just ignore that number. Not 22 also. 1 minute. It is not 22 also. 1 minute. Yeah. Please take illustration 25. Illustration 25, page number 411. It is illustration 9 as per the old edition book of the same syllabus. So just ignore the page numbers and the illustration numbers which is mentioned in the PDF. You can follow what I am saying. Please take illustration 25, page number 411. There is one more concept in Modigliani and Miller which I will explain in the next class. Have you all taken illustration 25? Have you all taken? Right. What is told in the question? A company's expected annual net operating income. They themselves are told EBIT. What is EBIT? Earnings before interest and tax. A company's expected annual net operating income is 50,000. Company has 2,10% debentures. Cost of equity, which is the equity capitalization rate of the company, is 12.5%. Find the value of the firm and overall cost of capital under net income approach. What were the formulae we suggested under net income approach? Under net income approach, the formulae were value of firm is value of debt plus value of equity. What is value of debt? It is interest divided by cost of debt. What is value of equity? It is earnings available to equity shareholders by cost of equity. What is value of firm? It is either value of debt plus value of equity or EBIT by overall cost of capital. Both will give you the same answer. Depending on what information we have, we will apply the respective formula. So now applying these formulae into that sum with some illustration 25. What is told here? They have told EBIT is 50,000. Debt is 2 lakhs. 10% is the interest rate. Cost of equity is 12.5%. So EBIT minus interest. How much is interest? 2 lakh into 10%, 20,000. This will give you equity earnings. This will give you earnings before tax. But what is the major assumption of net income approach? There are no corporate taxes. So the earnings before tax will be the same as earnings after tax. So equity earnings is 30,000. How do you find the value of equity? It is earnings available to equity shareholders, which is nothing but equity earnings, divided by cost of equity. How much is equity earnings? 30,000. How did I find that? EBIT minus interest. So this 30,000 divided by 12.5% will give you 2,40,000 as the value of equity. How do you find value of firm? Value of firm is value of equity plus value of debt. Value of equity is 2,40,000. Value of debt is 2 lakhs. Add them both. You get the value of firm as 4,40,000. Is this clear so far? They have also asked us for the overall cost of capital. I know that the cost of debt is 10%. How? Interest rate is 10%. So cost of debt is 10%. Cost of equity is 12.5%. Suppose when here they are asking you overall cost of capital, which means it is not 10% plus 12.5, 22.5. No. 10% is on the proportion of debt in total capital. 12.5% is the proportion is on the proportion of equity on total capital. So how do you find the overall cost of capital? It is 12.5, which is the cost of equity. How much is total capital? 4 lakh 40. How much is equity? 2 lakh 40. So 12.5 into 2 lakh 40 divided by 4 lakh 40 plus 10 is the cost of debt. How much is debt? 2 lakhs. How much is total capital? 4 lakh 40. So 2 lakh 40 divided by 4 lakh 40 will be the proportion of equity. 2 lakh divided by 4 lakh 40 will be the proportion of debt. Cost of equity into proportion of equity plus cost of debt into proportion of debt will give you the overall cost of capital. This overall cost of capital is not 12.5 plus 10. Instead, it is cost of equity into proportion in equity plus cost of debt into proportion in debt. That gives you 11.36%. Alternatively, overall cost of capital can also be found using the formula KO is equal to EBIT divided by value of firm. That also was told by Durand. How much is EBIT? It was given in the question as 50,000. How much is value of firm? That also we calculated as 4 lakh and 40,000. So 50,000 divided by 4 lakh 40 in one single step, you will arrive at 11.36%. The number will remain the same. The working only is different. Either way, you will get the same answer. Is this sum clear? Any doubts in this sum? You can ask me. Page number 412, illustration 26. Page number 412, illustration 26. Please take page number 412, illustration 26. Okay. So what is told in this sum? Assuming no taxes and given the earnings before interest and tax, interest at 10% and equity capitalization rate as below. Calculate the total market value of each firm under net income approach. What have I told you about net income approach? Under net income approach, the value of firm is measured as value of equity plus value of debt. How do we find the value of equity? It is earnings available to equity shareholders divided by cost of equity. How do you find value of debt? It is interest divided by cost of debt. So value of firm will be value of equity plus value of debt. What was the stand or what was the saying under net income approach? Debt is a cheaper source of finance. With more of debt in its capital structure, the value of firm will increase. That was the statement which was given under net income approach by David Durand. Okay. So now how are we going to solve this problem? They have given us the information for 4 different firms, X, Y, Z, and W. They have given us various EBITs, 2 lakh, 3 lakh, 5 lakh, and 6 lakh, minus interest. That interest amount also they have given, 20,000, 60,000, 2 lakh, and 2 lakh 40,000. EBIT minus interest will give you earnings for equity shareholders. Value of equity is found as earnings to equity shareholders divided by cost of equity. That cost of equity only they have given as K. It is 12%, 16%, 15%, and 18%. So equity earnings divided by cost of equity will give you the value of equity. What is the question? Calculate the total market value of each firm. How do you find the value of firm? It is value of equity plus value of debt. How did we find value of equity? It was equity earnings divided by cost of equity, which gave us the value of equity. For value of debt, it is interest divided by cost of debt. Interest amount is 20,000. What is the rate of interest? Look at the first line of the question. Interest at 10%. So 10% of interest works out to 20,000 rupees. It means on what value did you find that 10%? You would have found it on 2 lakhs. That will give you the value of debt. How do we find the value of debt? Value of debt is interest divided by cost of debt. So 20,000 divided by 10%, 60,000 divided by 10%, 2 lakh by 10%, 2 lakh 40 divided by 10%. This will give you value of debt. They are asking us for value of firm. It is value of equity plus value of debt, which will give you the value of firm. What is the question? Calculate the total market value of each firm. We have found. What other information they are asking? Below the table, if you could see, also determine the weighted average cost of capital for each firm. Weighted average cost of capital is nothing but overall cost of capital. While explaining the theory of net income approach, I told you all the value of firm can alternatively be found as EBIT divided by overall cost of capital. I will show you that formula 1 minute. Here. So, under net income approach, the value of firm can alternatively be found as EBIT divided by overall cost of capital. This overall cost of capital is what they call as weighted average cost of capital. How are we going to find this weighted average cost of capital? It is EBIT divided by value of firm. Now, I know EBIT in this question. I also have found the value of firm. So, how will I find KO or the overall cost of capital or the weighted average cost of capital? See, here we have arrived at value of firm. We were told about EBIT in the question itself. So, EBIT divided by value of firm into 100 will give you the overall cost of capital. This is what is asked in the question. But when we come to an understanding, what is told under net income approach? The value of firm will increase with more debt in its component. So, the debt earlier it is 2 lakhs, then 6 lakhs, then 20 lakhs, then 24 lakhs. With more of debt in the capital structure, the value of firm is increasing. Are you able to see that? The value of firm increases with more debt in its capital structure. One more thing is the cost of capital will be less. See, with debt being 60 lakhs, sorry, 6 lakhs, not 60 lakhs. With debt being 6 lakhs, the cost is 14.29%. But with debt of 24 lakhs, the cost is only 13.64%. So what am I doing? With more of debt, the cost is going down. Are you able to understand? Anyway, this interpretation was not asked in the question. They are asking you to find the value of firm and overall cost of capital. We have just found it. That's all. Is this some clear to all of you? Fine. Now, please take. The question numbers does not match in this notes. It's because of the addition. It does not matter. Please take illustration 29. Please take illustration 29. Page number 415. What is told in this sum? From the following data, find out the value of each firm and the value of each equity share as per Modigliani and Miller approach. What did I tell about Modigliani and Miller approach? It is an extension of net operating income approach where corporate taxes are considered by Modigliani and Miller, right? So what are the details given? They have given you the details for 3 companies, P, Q and R. EBIT, number of shares, 12% debentures. Every firm expects 12% return on investment. See, Modigliani and Miller approach you can apply only if the tax rate is given to us. Here, they have not given us information for tax rate. They have told EBIT, number of shares, 12% debentures, firm expects 12% return on investment. Only so much is given. You cannot assume tax rate for yourself. Hence, we will do this sum under Modigliani and Miller approach, but without corporate taxes. Why? Because tax information is not given. You cannot assume it for yourself. If I'm left to assume, some people will assume 30%, some people will assume 40%. So when it is left to assumption, there will be various answers. Hence, I am doing it without any assumption for taxes under Modigliani and Miller. Under Modigliani and Miller, how do you find the value of it is EBIT divided by overall cost of capital or the weighted average cost of capital. That is told as Every firm expects 12% return on investment. So for an investor, it is a return, but for the organization, it is a cost. So this cost of capital is 12%. For the three companies, P, Q, and R, how do you find the value of firm? EBIT divided by overall cost of capital. Have they given us EBIT in the question? Yes, 13 lakhs each. Divide by overall cost of capital will give you the value of firm. Later, they have told Modigliani and Miller approach in the question. They have asked you value of firm. Done. That is done. Then they are asking you value of each equity share. So how do you find the value of equity share? From the value of firm, if I subtract value of debt, I will get value of equity. I will come to this point of levered and unlevered firm after explaining this. I have found the value of firm as EBIT divided by overall cost of capital. From that value of firm, if I subtract value of debt, I will get value of equity. How much is value of debt? For P, it is nil. For Q, it is 9 lakhs. And for R, it is 10 lakhs. They have given 12% debentures. So value of firm minus value of debt will give you value of equity. But what have they asked in the question? The value of each equity share. So they are asking you the value for one share. How do you find it? The value of equity divided by the number of shares will give you the price per share. Now, under Modigliani and Miller, last class, I remember saying, I will come back to one concept a little later. Under Modigliani and Miller, a firm is classified into a levered firm and unlevered firm. What do you mean by a levered firm and an unlevered firm? An unlevered firm will not have debt in its capital structure. A levered firm will have both debt and equity in its capital structure. So, whenever a firm has a capital structure, which is the value of the firm, whenever such value comprises of both debt and equity, such firm is called as levered firm. If it is 100% equity, such firm is called as unlevered firm. For what am I going to use this concept of levered and unlevered firm? I will tell you. Is this sum clear? This sum is done. Is this sum clear to all of you? I found the value of the firm using the formula EBIT divided by K naught. Later, they have given me the value of debt. When I subtract it, I will get value of equity. They are asking you value per equity share. So divided by the number of equity shares to get the value for one share. Is the concept clear? Right. So now coming to that Modigliani and Miller concept which I left earlier. Modigliani and Miller approach. A firm which has debt in its capital structure is called a levered firm. A firm without debt in its capital structure is an all equity firm and is called an unlevered firm. How do you find the value of firm? Value of firm is value of equity plus value of debt. If a firm does not have any debt, such firm is called an unlevered firm. It is an all equity firm. How do you find the value of equity? Value of equity is earnings available to equity shareholders by cost of equity. This value of equity will be the same as value of unlevered firm because unlevered firm does not have debt in its capital structure. If this information is not given to me, I can alternatively apply EBIT into 1 minus T by KO. This T is corporate taxes. Because Modigliani and Miller person is a practical person. He says no organization can escape taxes. They have to pay taxes. Otherwise, the license of the organization will be withdrawn. So, the value of unlevered firm is value of equity. How do you find value of equity? It is earnings available to equity shareholders divided by cost of equity or EBIT into 1 minus T divided by KO. Now you can ask me, KO is overall cost of capital. How can KO be equal to KE? It can be same when there is no debt in its capital structure. When an organization does not have any debt in its capital structure, cost of equity will be the overall cost of capital to the firm. When there is no debt for which I have to pay interest, the entire earnings belongs to equity shareholders. So this formula and this formula are the same. Earnings available to equity shareholders, if they have given, you can take it straight away. If that is not given, the entire earnings made by the firm belongs to the shareholders in the absence of debt. Adjust it for taxes. Divide by KO. What is this KO? This is overall cost of capital. But it will be the same as cost of equity when there is no debt in the capital structure. After finding value of unlevered firm, with that, I can find the value of levered firm. What is value of levered firm? It is value of unlevered firm plus debt into tax rate. Now again you can ask me, how is it debt into tax rate? I remember explaining a concept in time value of money for cash flows running to perpetuity, where what is the cash flow because of debt? Because of debt, I have, here is the derivation. Derivation for debt into tax rate. For perpetual debt, they have not told about the redemption of debt. For a perpetual debt, how do you find return? How do you find the present value? It is cash flows divided by R. What is the cash flow because of debt? The tax saving on debt is a cash flow for the organization. If I have debt in a capital structure, I have to pay interest. That interest becomes an eligible expense to claim tax exemption. So, for the amount of interest, tax will be a cash flow, correct? That cash flow divided by R, which is again the interest rate. So what happens? Interest rate in the numerator and denominator gets cancelled. You end with debt into tax rate, which will become the value of debt. What is the value of levered firm? It is value of unlevered firm plus value of debt. How do you find value of debt? It is debt into tax rate. Why is it debt into tax rate? Because it is an irredeemable debenture. How do you find the return for perpetuity? It is cash flows divided by R. What is the cash flow because of debt that an organization will have? It will be tax saving, because interest can be claimed as an expense before booking your earnings for taxes. So debt into interest will give you the amount of interest. For the amount of interest, the organization will have tax saving. That is the cash flows. Divide by again the interest rate. So what happens? Interest rate in the numerator and denominator gets cancelled. You end with debt into tax, which will become the value of debt. Is the concept clear? A levered firm is one which has debt in its capital structure. An unlevered firm is an all equity firm. Is the concept clear? Right. So now let's proceed. Please take since the numbers have changed, I'm finding it difficult. 1 minute. Capital structure 30% debt, 70%. Yeah. Please take illustration 30. A firm which is an all equity firm is called an unlevered firm. A firm which has debt also as part of capital structure is a levered firm. The value of unlevered firm is nothing but value of equity only, because it is an all equity firm. How do you find value of equity? It is earnings to equity shareholders divided by cost of equity. If that information is not given, I can apply EBIT into 1 minus T divided by KO. KE will be the same as KO because there is no debt. Then earnings to equity shareholders will be the entire earnings made by the organization, because there is nobody to whom I have to pay interest. Net of taxes, that is what is important. This will give you the value of an unlevered firm. With this, how do you find value of levered firm? What is a levered firm? A levered firm has debt also as part of its capital structure. So value of levered firm is value of unlevered firm plus debt into tax rate. Value of a firm is value of equity plus value of debt. From where did this tax rate come up? That is what I intended to explain. For a perpetual investment, the present value of return is measured as cash flows divided by R. So what is the cash flow because of investing, because of having debt in the capital structure? It is the tax saving. How much is the tax saved on debt? It is for the amount of interest. So the cash flows will be debt into interest into tax. Divide by R again, which is interest. So interest in the numerator and denominator gets cancelled. You will end up with debt into tax rate as the value of debt. Is it clear now? Is it clear now? Fine. So now please take illustration 30. Just ignore the numbers in the notes. It is from the older edition of the textbook. Please take illustration 30. Z company has a capital structure of 30% debt and 70% equity. The company is considering various investment proposals costing less than 30 lakhs. The company does not want to disturb its present capital structure. The cost of raising the debt and equity are as follows. Above 5 lakhs, cost of debt is 9%, equity is 13%. Above 5 lakhs, up to 20 lakhs. Is it 29? Okay. In my book, it's 30. After this, maybe you might have got another edition. So it seems it's illustration 29. Please take it. Above 5 lakhs, it is 9% and 13% for the cost of debt and equity. Above 5 lakhs, up to 20 lakhs. Above 20 lakhs, up to 40 lakhs. Above 40 lakhs, up to 1 crore. Assume the tax rate is 50%. Compute the cost of two projects A and B, whose fund requirements are 8 lakhs and 22 lakhs respectively. If the projects are expected to yield an after-tax return of 11%, determine under what conditions it would be acceptable. Okay. So now, how much is the cost of the project? Cost of the project is 30 lakhs. Okay. How are they going to make a composition for debt and equity? They have told it is 30% debt and 70% equity, which means it is 0.3 and 0.7 for debt and for equity. How much is the investment required? They have told 30 lakhs. The company is considering various proposals. So, right. Now coming to two plans, A and B. For plan A, how much is the investment required? Look at below the table. Assume the tax rate is 50%. Cost of the project A and B, whose fund requirements are 8 lakhs and 22 lakhs. What was the total money they wanted? 30 lakhs. That 30 lakhs, they have divided it as investment in A to the extent of 8 lakhs and for B, 22 lakhs. So you get total 30 lakhs. Okay. This 8 lakhs, out of this, 30% is debt and 70% is equity. Likewise, out of this 22 lakhs, 30% is debt and 70% is equity. Now coming to cost of equity. Why am I bothered about the cost of equity? They have told the slab. Here, the investment required is 8 lakhs. Okay. For that 8 lakhs, which slab does it fall into? It falls into the second slab. What is the second slab? It is above 5 lakhs up to 20 lakhs. The amount required is 8 lakhs, correct? For project A, which means it falls into the second slab. What is happening for the second slab? The cost of equity is given as 14%. Cost of debt is given as 10%. But we know in case of debt, we will have tax saving. What is the tax percentage given? They have told assuming tax rate as 50%, which means net of tax saving, how much will be your cost? It will be only 5%. Why? Because for the interest paid, you will have tax saving. So cost of debt must always be considered after tax. Cost of debt is given as 10%. Net it out for tax saving, you will have a net cost of 5%. Likewise, look into B. How much is the investment required for B? 22 lakhs. Which slab does it fall into? It falls into the third slab. For the third slab, how much is the cost? Cost of equity is 15%. Cost of debt is 11%, but net it out for tax saving. So 11% into 1 minus 50%, which will give you 5.5% as cost of debt after tax. Okay. Now, with this, what are they asking you for? If the project is expected to yield a return of 11%, determine under what conditions it will be acceptable. Here, it is a composition. The capital required for project A is 8 lakhs and for B is 22 lakhs. But this money is a composition of debt and equity. So how do you find overall cost of capital? It is not 14 plus 5. No, it is 14 into proportion of equity out of total investment plus 5 into proportion of investment in debt. Likewise, for project B also. So, for the overall cost of capital of A, what is overall cost of capital? It is cost of equity plus cost of debt, but not just randomly adding them. It is not 14 plus 5 straight away. 14% is the cost, yes, agreed. But for the proportion of equity in total investment. Likewise, 5% is cost of debt for proportion of debt in total investment. So how do you find it? It was told 30% is debt and 70% is equity. So 5 into 30% plus 14 into 70% will give you overall cost of capital for A. Likewise, find overall cost of capital for B. It is 5.5, which is cost of debt, into 30%, which is the proportion in debt, plus 15% is cost of equity, into 70% being the proportion in equity. This will give you the overall cost of capital. What is the question? If the project is expected to yield a return of 11%, determine under what conditions it would be acceptable. There are two projects A and B. A required investment of 8 lakhs, B required investment of 22 lakhs. We have just found the overall cost of capital. But how much is the return? After tax return is given as 11%. The project yields returns less than the cost. So the return is less than the cost of capital. Both projects are rejected as cost of capital is greater than return. Project can be accepted only if return is more than the cost of capital. Could you understand? They are asking under what conditions will the project be acceptable? When will you accept a project? Only if you make profits. Here the cost is more than the return. So you are at loss if you are going to accept the project. So you will conclude saying the project should not be accepted as the cost is more. Is this some clear? Is it clear to all of you? Fine. Now, please take illustration 31. Please take illustration 31. Company X and Company Y are in the same risk class and are identical in every fashion, except that Company X uses debt, while Company Y does not. The levered firm has rupees 9 lakh debentures carrying 10% rate of interest. Both firms earn 20% before interest and taxes on their total assets of 15 lakhs. Assume perfect capital market, rational investors, and so on, a tax rate of 50% and capitalization rate of 15% for an all-equity company. Compute the value of firm X and Y using net income approach. Compute value of each firm under net operating income approach. Using NOI approach, calculate overall cost of capital for firms X and Y. Which of the two firms has an optimum capital structure according to NOI approach? So here they are asking us for value of firm under a net income approach and net operating income approach. But in the paragraph of the information which is given to us, they have told the levered firm has 9 lakh debentures. Both firms earns 20% before interest and tax. Assume perfect capital market and tax rate of 50% is given. So I have explained the theory already where I told net operating income approach is an extension of Modigliani and Miller approach, right? Where Modigliani and Miller is more realistic. He says there are corporate taxes. So Modigliani and Miller approach is just an extension of NOI approach. And since this form sum classifies a firm into levered and unlevered firm, who did this classification? It was done only by Modigliani and Miller. Hence, the sum has to be solved under Modigliani and Miller approach, although the question says net operating income approach. So, although they have told net operating income approach, we will do it under Modigliani and Miller. Anyway, the answer is not going to get wrong because it is only an extension of NOI approach. Okay. So, first subdivision, there should be no problem. It is under net income approach. What happens under net income approach? They have told the company has both firms earn 20% before interest and tax on their total assets of 15 lakhs. So on 15 lakhs, apply 20%, you will get EBIT. Correct? With this value of EBIT minus the interest rate. How much is interest? 9 lakh into 10%. So 90,000 is interest. This will give you earnings to equity shareholders. First subdivision, they are asking you under net income approach. What is under net income approach? Under net income approach, there are no corporate taxes. So just ignore taxes. Earnings to equity shareholders divided by cost of equity will give you value of equity. Plus value of debt will give you value of firm. For the first subdivision of the question, they are asking the value of firm under net income approach. Under net income approach, you cannot consider corporate taxes. So I am just ignoring corporate taxes and writing EBIT minus interest earnings to shareholders. Divide by cost of equity will give you value of equity plus value of debt of 9 lakhs will give you the value of firm. Then coming to the value of firm Y. What is happening with Y? With Y, company X uses debt while Y does not. Which means for Y, it is an all equity firm. For an all equity firm, the entire earnings will belong to the equity shareholders. Correct? For an all equity firm, the cost of equity will be the same as overall cost of capital. So it is 3 lakh divided by 15%, which will give you the value of equity, which is the same as value of firm. Is it clear so far? In the first subdivision, they have asked us for value of firm under net income approach, and hence I ignore corporate taxes. For the second subdivision, they have asked us to find the value of firm under net operating income approach, but with the information given here and there, they have told about tax rate, they have told about levered firm and unlevered firm. All this classification happens only under approach. Hence, I am doing this sum under approach, which is an extension of NOI approach. So, what will happen under approach? A firm is classified into a levered firm and an unlevered firm. With the information given, how do we identify X uses debt, which means X is a levered firm, Y is an unlevered firm. How do you find the value of an unlevered firm? It is EBIT into 1 minus tax rate divided by K0, or earnings to equity shareholders divided by cost of equity. Please remember, we are doing this sum under approach, where I have to consider corporate taxes. So it is 3 lakh into 1 minus 0.5 divided by 15%, which will give you 10 lakhs as the value of unlevered firm. Having found the value of unlevered firm, with this I can find the value of levered firm. I just explained the formula. Value of levered firm is value of unlevered firm plus debt into tax rate. So it is 10 lakhs plus 9 lakh into 50%, which will give you 14 lakh and 50,000 as the value of firm. From value of firm, if I subtract value of debt, I will get value of equity. So, for finding the value of firm under approach, you have to first find the value of an unlevered firm. After finding that, take that value to the levered firm and then add debt into tax rate to get the value of a levered firm. After getting the value of levered firm, subtract value of debt to know the value of equity. So value of firm X is 14 lakh 50. Value of firm Y is 10 lakhs. What other information they are asking? Using NOI approach, calculate overall cost of capital. How do you find overall cost of capital? See, using NOI approach. NOI approach means it is Modigliani and Miller now. Okay. So they are asking you overall cost of capital for X and for Y. So how are we going to do that? We know EBIT is 3 lakhs. Minus interest will give you earnings before tax. Minus tax at 50% gives you earnings to shareholders. 1 lakh 5,000 is the earnings to shareholders. For how much of equity? 1 minute. 5 lakh 50,000. Yeah, value of equity is 5 lakh and 50,000. 1 lakh 5,000 is the earnings to shareholders for 5 lakh 50,000 of equity, which means how much is the cost of equity? It will be 19%. Now, how do you find overall cost of capital? It is cost of debt into proportion in debt plus cost of equity into proportion in equity. Cost of debt. Interest rate is given as 10%, but we are supposed to consider after tax cost of debt. After tax cost of debt will be 5% only. Interest rate is given as 10% into 1 minus 50% of tax. So I will get cost of debt as 5% into the value of debt divided by value of firm. This will give you the proportion of debt in capital structure plus cost of equity. I have arrived as 19%. 19% into value of equity divided by value of firm. Value of equity by value of firm will give you the proportion of equity. So within the bracket values, this will give you the proportion of debt and this will give you the proportion of equity. Add them both, you will get overall cost of capital for company X. But for Y, what happens? For Y, it is an unlevered firm. Cost of equity will be the same as overall cost of capital. What was overall cost of capital for Y? There is no tax, nothing for Y. No, we have. Overall cost of capital is, there is no interest, not tax. I'm sorry. There is no interest cost for an unlevered firm because there is no debt in its capital structure. Overall cost of capital, they have told capitalization rate of 15% for an all equity company. So unlevered firm is an all equity company. Hence cost of equity is overall cost of capital and it is 15%. Comparing the overall cost of capital, for X it is 10.31%, but for Y it is 15%. This is cost to the company. So which is having more cost? Unlevered firm is having more cost. So what is the last subdivision of the question? Which of the two firms has an optimum capital structure? X has a better capital structure as its overall cost of capital is less. That's all. Is this some clear? Although they have asked us under NOI approach, we have to do it under approach because they have classified the firm into levered and unlevered firm. Also, they have told about corporate taxes, cost of debt. KD is cost of debt. KE is cost of equity. KO is overall cost of capital. Is it clear? Fine. Now, please take illustration 32. In my book, it's 32. A company's current operating income is 4 lakhs. Is it 32? Right. A company's current operating income is 4 lakhs. The firm has rupees 10 lakhs of 10% debt outstanding. Its cost of equity capital is estimated to be 15%. Determine the current value of the firm using traditional approach. So traditional approach was told by Solomon, correct? So traditional approach was observed. Why? Because they said debt is a cheaper source of finance up to a certain level. Beyond that level, debt becomes an expensive source of finance. What is that level? That level was not clearly specified. Hence, that theory was considered absurd. Anyway, here they have asked us for determining the value of firm using traditional approach. Calculate the firm's overall capitalization rate as well as the leverage ratios, B by S and B by V. B by S means borrowings by shareholders' funds. B by V means borrowings divided by value of firm. So they are asking for those two ratios as well. So how are we going to proceed? They have told current operating income is 4 lakhs minus interest. How do you find interest? 10 lakh into 10%, 1 lakh is the amount of interest. EBIT minus interest will give you earnings to shareholders. Divide by cost of equity will give you value of equity. You already know value of debt as 10 lakhs. Value of equity plus value of debt will give you value of firm. Okay. Then they are asking you for overall capitalization rate. So KO is equal to EBIT divided by value of firm. So the formula will remain the same as under NI approach. Okay, net income approach. The formula will remain the same for the traditional approach also. Overall cost of capital is EBIT by value of firm. How much is EBIT? It is 4 lakhs. EBIT is 4 lakhs. How much is value of firm? Value of firm is 30 lakhs. So 4 lakhs divided by 30 lakhs. Overall cost of capital is 13.33%. They have also asked for B by S ratio and B by V ratio. B by S is borrowings divided by shareholders' funds. How much is borrowings? The firm has 10 lakhs of 10% debt. So 10 lakhs is borrowings. Divide by shareholders' funds is nothing but value of equity. What was the value of equity we found? We found it as 20 lakhs. That is shareholders' funds. So B by S is borrowings divided by shareholders' funds. B by V is borrowings divided by value of firm. So they are just asking you to find those ratios, you find and leave it as it is. That's all. Is this sum clear? Is this sum clear? Fine. Now, as regards capital structure, value of firm is value of debt plus value of equity. Value of equity will be the value of firm in case of an unlevered firm. Not the future assumption, it is the present value of the firm. If you have to sell a business, you're running a firm, if you want to sell the business, what price will you quote for your business? Based on finding your value, that value is the value of firm. It is the present value for the firm, not the future value, present value. You should know your worth as and when you grow, right? Is the concept clear? Now, there may be a few sums which are included in your latest edition of textbook. I will quickly finish them and then we will move on to the next topic, which is cost of capital. Okay, please take illustration 22. Please take illustration 22. 1 minute, I'll stop sharing this and bring in your study material. Just a minute. As regards my notes,